Welcome back to the deep dive. We've got some really interesting material you've shared today, all looking at the global economy for the second half of 2025.
Yeah, it's quite an outlook report.
It really is. And our mission today, well, it's pretty straightforward. Unpack the key insights, look at the scenarios they're painting for the U.S. and, globally,
Mm,
and really dig into the investment strategies they recommend in this kind of uncertain world.
exactly. Think of it as getting you the core nuggets from this analysis.
Perfect. So where does the report start? What's the big picture takeaway?
Right away, it puts the central idea out there. Tariffs and significant U.S. policy uncertainty are really expected to weigh on global growth.
Okay, so it's not just U.S. policy mattering, but the uncertainty itself is a global headwind.
Precisely. That's a key point. And the report stresses it's not the same everywhere. It sees pretty varied outcomes across different regions, especially Asia and emerging markets.
Yeah.
And what they highlight is that countries that have the ability, the room to use expansionary policies, spending more, cutting taxes maybe, and reducing interest rates, they're just better equipped to handle these kinds of external shocks.
Okay, so domestic flexibility is crucial. And for investors, what's the initial advice for navigating this?
The general steer is towards, well, agile investing, keeping up portfolio diversification and leaning into defensive sectors because volatility is expected.
Mhm.
And they really emphasize that active stock selection is like key in this environment, not just nice to have, but crucial.
Got it. Nimble, diversified, focus on quality, be selective. Okay, let's zoom in on the U.S. then, since it's sort of the source of this uncertainty wave. What does the report actually say about the U.S. growth outlook for later this year?
Well, it outlines a few possibilities. There's a potential upside scenario, but they're quick to say it's unlikely.
Okay, what would that best case look like?
In that scenario, U.S. consumers somehow just keep spending, even with higher prices maybe. The report does point to the current labor market strength, 177K new jobs, unemployment at 4.2%, real payroll income up over 3%.
Right, that's pretty solid.
Yeah, so households could theoretically dip into savings more, even though the savings rate is already quite low historically at 3.9%, it has been lower, like 1.8%.
Okay. Any other potential boosts in that scenario?
A small one from lower oil prices maybe adds like 0.3% to 0.5% of GDP. But this whole upside really hinges on getting swift, big tariff reductions, especially with China, and new trade deals happening fast. That's the best case they lay out.
But unlikely, you said. So what's the more probable path, according to this report?
The base case, which they judge more likely, is for pretty subdued U.S. growth. They're forecasting something in the range of 1.2% to 1.5% for the year.
Okay.
And importantly, the risks are skewed to the downside.
And that slower growth, is that directly linked back to the tariffs we started with?
Absolutely. Even what they call the commonly expected tariff outcome, say 10% generally, 30% on China, with some exclusions, that alone means the U.S. effective tariff rate jumps over 10% compared to last year.
Right.
And here's the kicker. The report equates that jump to a tax hike of about 1.5% of GDP.
Wait, hang on. A tax hike? How do tariffs become a tax hike for Americans?
Yeah, that's how they frame it, because tariffs are paid by importers, right? But those costs usually get passed along to consumers in the form of higher prices, so it hits household purchasing power, like a tax on buying stuff.
Ah, okay. I see the logic.
And they call this specific 1.5% of GDP increase one of the largest single-year hikes in decades. So it really cuts into household income.
That paints a clearer picture of the impact and those trade deals that could potentially help. Well, they aren't exactly quick fixes, are they?
Definitely not. The report really underscores that trade negotiations tend to be long, drawn-out affairs. It mentions complexities and potential deals with Japan, Korea, India, and notes reported struggles with the EU.
Any signs of friction there?
Yeah, it mentions the EU apparently had a list of potential retaliatory tariffs ready, worth around USD 107 billion back in mid-May. So it's not just a one-way street.
Right. The risk of things escalating.
Yeah.
Beyond this subdued base case, what's the specific risk scenario the report is worried about?
A key one is this potential struggle for the economy to reallocate labor. Basically, if consumers shift spending away from goods, maybe because tariffs make them pricier and towards services.
Which seems plausible.
Right. It could lead to layoffs in goods-related sectors like manufacturing, trade services, smaller businesses. The risk is that these layoffs happen before hiring really picks up strongly in the service sectors.
Why would that gap happen? Is it a skills mismatch or?
Could be a mix of things. Skills, location, just the timing of hiring versus firing.
Hmm.
The report calls it a reallocation struggle. So you could get rising unemployment temporarily, which then scares households into spending less.
Creating a negative feedback loop.
Exactly. Businesses see demand fall, they cut more workers, it could get messy.
That does sound painful. And the absolute worst case scenario if things really go south.
The worst case they outline is if that initial 90-day pause on new reciprocal tariffs just doesn't lead anywhere, no meaningful deals,
Then what?
then U.S. tariffs could rise sharply. The report argues that would hit consumption and employment hard enough to potentially tip the U.S. economy into recession by the end of the year.
Wow. Okay, so a really wide range of outcomes for the U.S., heavily leaning on how these tariff and trade issues play out. How does the Fed fit in? What are they expected to do with interest rates amidst all this?
The report actually gives some pretty specific triggers they think the Fed is watching for rate cuts.
Oh, like what?
They expect cuts if two things happen. One, the unemployment rate rises above, say, 4.4% to 4.5%, and two, weekly initial jobless claims go over 350,000 on a 4-week average.
So not just overall unemployment, but the rate of new job losses needs to pick up too.
Got it. And if those triggers hit.
If both conditions are met, the report suggests we could see 2 25 basis point cuts by September or October, a basis point being 1/100%.
Exactly. So a 0.25% cut twice. And if job claims were to spike even faster, say above 400,000, they even mention a possible 50 basis point cut.
Okay, that's a clear path for easing. But what about the other side? What if unemployment stays pretty low, below 4.4%, but tariffs push inflation up?
That's a really tricky spot for the Fed, isn't it? The report suggests if unemployment and claims stay stable below 4.4% and 300K respectively, but inflation is rising because of tariffs, the Fed might just hold rates steady for longer.
They'd wait.
Yeah. In that scenario, they'd likely need to see household inflation expectations actually fall back towards 2024 levels before they'd feel comfortable resuming cuts. And even then, it might just be cautious, 25 basis point cuts every other meeting.
It really highlights the tightrope they're walking, balancing slowdown risks with these tariff-induced price pressures.
Okay, let's widen the lens again. The ripple effect. How does this U.S. base case tariffs, uncertainty, slower growth hit Asia? Generally, the report expects slower growth across Asia as a result. But interestingly, it also forecasts lower interest rates and potentially stronger currencies in the region.
Okay, let's break that down. China first. What's the outlook there, considering the tariff situation?
For China, the report notes the recent U.S. tariff changes. The weighted average rate came down quite a bit from peaks, but it's still around 35%. The report figures this still implies about a 1% of GDP headwind for China's growth this year.
But how's their growth looking overall?
They still forecast GDP growth around 4.4%. The key thing mitigating the slowdown, according to the report, is Beijing's response. They've announced fiscal stimulus, nearly 2% of GDP already, with maybe more coming, plus rate cuts, increased special lending. They're actively pushing back.
Right, using those policy levers we talked about. Now, India. The report called it potentially Asia's largest winner. That's a big claim. Why India?
It is a strong statement. The main reason is that India's direct export exposure to the U.S. is actually the second lowest in Asia, only about 2.2% of its GDP, so it's just less directly hit by U.S. tariffs compared to others.
Less direct vulnerability.
Exactly. Plus, the report suggests a potential trade deal could really boost India's position as an alternative manufacturing site for companies looking to diversify supply chains. China plus one, that kind of thing.
So low risk and potential upside from shifting trade patterns.
Pretty much. And combine that with a decent inflation picture headline. Inflation was 3.2% in April, below the Reserve Bank of India's target of 4%. That gives the RBI room to cut rates. The report expects maybe 50 to 75 basis points more cuts by year end. Add in strong growth forecasts, 6.3% this year, 6.5% next, and you can see why they're relatively optimistic about India.
Lower exposure, policy room, strong growth.
Okay.
Now, what about Japan?
Japan's growth outlook, around 0.6% to 0.8%, is seen as somewhat tied to getting a trade deal done with the U.S. Exports, usually a big driver for Japan, are likely to weaken a bit under the tariff clouds.
But is there anything offsetting that?
Yes, and this is important. The report highlights rising wage growth in Japan. That's expected to help boost domestic consumption, partially making up for weaker exports.
Domestic demand picking up in Japan, that feels like a shift. And ASEAN, Southeast Asia, is it a mixed bag there?
Very much a mixed bag, according to the report. The more trade-dependent countries, Vietnam, Malaysia, Singapore, Thailand, they're likely to see growth slow down maybe 0.5% to 2.0% because of weaker exports.
But not all of them.
No. Indonesia and the Philippines are expected to be less affected. The Philippines, in particular, is forecast to keep growing at a pretty solid 5.6%.
Okay, so it really varies by trade exposure. Now, shifting back to the U.S. briefly, there are planned tax changes. Could those maybe offset the tariff drag, give equity markets a boost?
The report tackles this head on, and its conclusion is pretty clear. Probably not much impact on equities from the budget itself.
Really? Why not?
Well, it notes markets did rally sometimes on trade talk news or decent more economic data from earlier in the year, before the tariffs really bit. But it warns that export and industrial production data, likely weakening from May onwards and reported in June, could start weighing on stocks, especially in countries without good news on trade deals.
Okay, and the tax changes themselves, are they significant cuts?
This is the crucial point the report makes. Most of the planned U.S. tax changes aren't really new cuts for 2025. They're mostly about preventing a scheduled tax increase in 2026 when parts of the 2017 Tax Cuts and Jobs Act expire.
So it's more about maintaining the status quo than new stimulus.
Exactly. There's talk of some small cuts like for overtime or tips, but probably with tight limits. And here's the key. Congress is reportedly looking at spending cuts to help pay for extending those current rates. And the report stresses the tariffs, which act like that tax hike we discussed, are not factored into these budget plans.
So the budget isn't designed to offset the tariffs,
Mhm.
and the tariffs aren't accounted for in the budget math.
That's the takeaway. So the report concludes the budget itself is unlikely to boost equities much. If anything, it points to a negative long-term issue for U.S. Treasuries.
How so?
These budget talks imply roughly a USD 4 trillion increase in federal debt over the next decade. And the report notes market concerns about this already seem to be pushing longer-term Treasury yields up a bit. Although yields could still dip later this year if U.S. growth slows significantly.
Before maybe snapping back higher later.
Potentially, yeah. Maybe late 2026 during a recovery phase.
That's a huge debt increase. Let's talk about the U.S. dollar itself. Its role as the reserve currency. Does the report see that changing?
It acknowledges the practical realities. The U.S. is the biggest economy. Other government bond markets just aren't as big or liquid globally. So the USD is likely to stay the main reserve currency for the foreseeable future.
But are there near-term pressures on the dollar's value?
Yes, definitely. The report sees several factors likely pushing some money out of the dollar over the next year or so. Things like weaker U.S. growth compared to elsewhere, the Fed cutting rates, that rising U.S. debt we just mentioned, and just ongoing geopolitical stress.
So what's the expectation for the dollar's exchange rate?
Given the dollar is seen as expensive currently, the report expects it to weaken, maybe by at least 4% in broad terms, potentially even as much as 10% over the next year.
Okay, a weaker dollar. How does that impact Asian currencies?
Most are expected to strengthen somewhat against a weaker dollar. And here's a really interesting point the report makes. It thinks Asian central banks might actually allow more of that appreciation than they have historically.
Why would they do that? Isn't a weaker currency usually better for exports?
It can be, yes. But the report suggests a key reason now is political. During trade negotiations with the U.S., letting their currency strengthen naturally helps them avoid accusations of currency manipulation, unfairly keeping it weak for trade advantage.
That's a clever geopolitical angle affecting policy. Does a stronger currency help them domestically too?
Absolutely. For Asian economies where inflation is already low or below target, a stronger currency helps keep import prices down, giving inflation even less room to rise. This, in turn, gives their central banks more freedom to cut interest rates to support their own economies.
So it's a combination. Stronger currencies potentially, plus room for rate cuts.
Exactly. And the report argues this combination should make Asian asset markets look more attractive for international investors.
Okay, so even with global uncertainty, there are specific dynamics favoring Asian assets. Given all this volatility and complexity, what are the practical investment strategies the report suggests for you, the listener?
Well, it frames volatility not just as a risk, but also as something that creates dislocations, which agile investors can potentially use. For Asia and emerging markets specifically, it really hammers home a bottom-up approach, meaning focusing on finding individual companies, ones with strong long-term fundamentals that happen to be trading at attractive prices, rather than just making big bets on entire markets going up or down.
And beyond stock picking, any other tools or approaches mentioned?
It talks about using derivatives were allowed to manage risk or maybe enhance returns, and also this idea of banking wins, basically. Taking profits when you have them to build up some cash, reduce risk, and maintain stability if markets suddenly turn down.
Seems prudent.
And they stress using good data, good risk management tools, and constantly stress testing your portfolio against different scenarios, being aware of the assumptions you're making.
So for you, the investor trying to build a resilient portfolio now, what's the core message?
Diversification is key. The report suggests maybe rebalancing away from markets that look overvalued towards those with better valuations and improving fundamentals, like some we've discussed in Asia.
Oh.
Also, steady income from high-quality bonds and dividend stocks can help smooth out the ride when earnings are uncertain. And they specifically mention low volatility strategies.
How do those help?
They're designed to cushion the downside when markets fall while still letting you participate in gains. That's important because recovering from big losses can be really tough for long-term returns.
Makes sense. Build in some shock absorbers. Okay, let's dive into those specific Asian equity markets the report highlights. Japan, India, China. Japan had a great run. Can it keep going?
The report acknowledges that early 2025 was tougher for Japan's big exporters, partly due to the stronger yen and those U.S. tariff threats. Smaller companies actually did better for a bit. Progress on tariffs could help sentiment short-term.
But are there longer-term reasons for optimism?
Yes, and the report really focuses on these. There's real momentum in corporate reform. More dividends, more share buybacks, companies unwinding those complex cross-shareholdings, basically becoming more shareholder-friendly.
Any examples?
It mentions a big automaker's recent bid to take a subsidiary private as something that sparked optimism about wider restructuring. Plus, the Tokyo Stock Exchange itself is pushing hard for better governance. The report calls this an idiosyncratic, unique to Japan source of potential returns, not just tied to global ups and downs.
So internal changes are driving things.
That and something else, huge. Japan is seeing its highest nominal wage growth in over 30 years.
Really? Why now?
Labor shortages, easing deflation, it's feeding through. This supports domestic spending, which is crucial if exports are weak, and it also pushes companies with big cash piles to actually use that cash to improve returns.
Interesting.
So the conclusion is Japan still looks cheap on some measures, like price to book, has strong earnings and cash flow, and these unique internal drivers make it compelling long-term.
Sounds like a fundamental shift.
Yeah.
Okay, India. We noted it's a potential tariff winner, but often gets called expensive. Why has its market held up so well?
Yeah. Despite those valuation worries, India's resilience is partly down to the Reserve Bank of India. The report calls their stance dovish and pro-growth.
Meaning they're prioritizing growth.
Exactly. More focused on supporting growth than just fighting inflation right now. They've already cut rates twice this year, and with inflation looking contained, the report sees another 50-75 basis points of cuts likely by year-end.
Okay.
And crucially, the RBI also injected liquidity into the banking system earlier, which apparently eased a key constraint they had back in 2024.
So central bank support has been really important there.
Definitely. That plus strong buying from domestic investors and foreign investors turning into net buyers recently, it creates a positive flow picture.
Right.
And the report reiterates India's relative insulation from U.S. tariffs due to its big domestic economy and lower export exposure, except for IT services, which aren't tariffed anyway. Q4 earnings were also decent. So RBI support, stable oil, domestic buying. It's a good backdrop. Even if valuations might cap gains eventually, active managers can still find plays.
Makes sense. And finally, China equities. The stance was cautiously optimistic. Still the case.
Yes, that holds for the medium to long term. The report sees attractive valuations in both Hong Kong-listed H shares and mainland A shares, offering chances for stock pickers.
Any other factors?
They note that because expectations for massive stimulus were lowered after the April Politburo meeting, there's actually less risk of disappointment now, and maybe even room for positive surprises if more targeted support comes through.
Are there signs the economy is holding up okay?
The report points to some encouraging data from the May Day holiday tourism, retail sales, Macau gaming revenue all showed increases, and it highlights something called southbound flows.
Southbound flows, what's that?
That's money from mainland Chinese investors buying stocks listed in Hong Kong, H shares. The report says these flows have been huge, like USD 78 billion just this year so far.
Wow.
That's apparently more than doubled mainland ownership of H shares since 2021, making that market potentially more resilient if foreign investors get nervous.
A big internal buyer. But U.S.-China tensions haven't gone away?
No, definitely not. Volatility remains high because of that. So the report favors Chinese companies with specific qualities: stable shareholder returns, strong competitive positions, and more predictable earnings growth.
Okay.
And interestingly, it suggests combining China and India in a portfolio could offer good diversification because their markets often move for different reasons. Low correlation.
That's a helpful perspective. Okay, we've covered equities thoroughly. What about bonds? In this uncertain world with potential rate cuts, what's the play?
The baseline recommendation is global diversification in bonds too. But strategically, the report suggests rotating towards countries set to benefit from things like tariff de-escalation, supply chain shifts, or strong domestic support.
And within those markets.
The focus is on credit quality, prioritizing defensive sectors, government debt, quasi-government entities, utilities looking for high-quality bonds at good prices.
How does the slower growth outlook feed into this?
Slower growth generally signals central banks will lean towards being more accommodative, especially where inflation is under control. And this is where the report gets quite positive on Asian local currency bonds.
Why specifically those?
Because they offer attractive real yields, that's yield minus inflation, and the underlying economies look relatively resilient. Plus, they offer diversification because they don't always move in sync with US or European bonds.
Right.
Their inclusion in major bond indices also helps support demand. So the strategy is to potentially add duration, meaning buy longer-term bonds, to benefit more from falling rates in Asia and EM local bonds if there are significant sell-offs, positioning for those potential rate cuts.
And currencies.
Yeah.
Any tactical views there?
Tactically, it mentions looking for extreme downward moves in the US dollar as opportunities to maybe buy some USD as a portfolio hedge, just in case of unexpected global shocks.
Even with the longer-term weakening view.
Yes, because despite longer-term concerns about U.S. debt and the dollar's reserve status, U.S. Treasuries are still seen as the ultimate safe haven in a crisis because of their size and liquidity. Think back to the COVID shock, that's where money fled initially.
Got it. Near-term safety valve versus longer-term pressures. Okay, we have covered a lot of ground here. From the overarching U.S. policy uncertainty down to specific bond strategies, the report seemed to boil it down to 5 main investment themes. Can we just quickly recap those for you?
Absolutely. It's a good way to summarize. The 5 themes they identified are: 1, enhancing portfolio diversification. It's basically looking beyond potentially expensive U.S. assets. 2, identifying tariff winners. Like India, less exposed and potentially benefiting from supply chain shifts. 3, harnessing policy opportunities, capitalizing on specific policy actions, say in China or Japan. 4, navigating rate cuts, focusing on ASIAMs where central banks have room to ease. 5, building portfolio resilience, using quality income and low volatility strategies to protect the portfolio.
That really crystallizes the key action points from the analysis. We've certainly done a deep dive today unpacking how these big global forces, tariffs, U.S. policy, regional strength, central bank moves create this really complex picture for the rest of 2025. It's full of challenges, but also, as the report highlights, some very distinct opportunities.
It really underscores the need for a nuanced approach, doesn't it? Balancing the risks with finding those specific areas of potential.
It really does. So building on everything we've just gone through from this material, here's maybe a final thought for you to consider. In this kind of environment where big policy shifts are causing so much turbulence, how do you effectively balance that need for being defensive, for being diversified, with the agility you need to actually grab those specific opportunities that pop up because of unique policy actions or regional growth stories like the ones identified in this analysis? Something to chew on as you think about your own strategy in these very interesting economic currents.